Should we run? Should we continue to embrace AI? We're going to talk about that today on the Zone Show. Hey everybody, I'm Chris Lavin, and my friend is on site again, Mr. Nate Armstrong.
Hey guys, let's rock this, Chris.
All right.
So on top of AI, they say that the big threat is that they're going to steal all the jobs, and it's now entering the multifamily housing arena. We're going to talk about that today. On top of that, we had $100 million property management company just sell for $8 million bucks. Literally, like wiped out $92 million. We'll talk about that. Why? And then Chris, the ex-Chicago Housing Authority head, we're talking HUD of Chicago, just got caught in a $4.8 million ringer. And we'll talk about that in a little bit more. First, though, we've got the proverb and the blessing of the day. So, Chris, I'll do the proverb. You ready for the blessing?
Yes, sir.
All right. Proverb 11:5. It goes like this: the godly are directed by honesty. The wicked fall beneath their load of sin. It's funny, I saw a dude that was running basically a ring of renting apartments illegally, and that guy is now probably going to jail. And so when people do bad things, they fall underneath the weight of their sin. Chris, with that said, would you mind kicking us off with a blessing?
Absolutely. Absolutely. Heavenly Father, first and foremost, I want to thank you for the amazing blessings that you bestowed upon my life and the life of the people that are around me. I ask that you bless Nate tonight's conversation and give us the wisdom so that we can give to the people that are listening the things they need to be nourished intellectually so that they can go out and live a happy and financially worry-free life. I ask that you just please continue to bless these conversations and continue to bless the people that are following us. I ask all of this in your name. Amen.
Amen. So Chris is in office in studio right now, and I am on location at our newest deal. And we'll talk about that a little bit later. Those of you that have been looking for your real estate deal, we'll talk about this one. First up, though, Chris, we got AI kind of dominating the headlines, but it's not always talked about in our industry. And in multifamily, it's creeping in. There's some analysts right now that are saying that they're anticipating that it's going to cause a big disruption. We're going to see 10, maybe up to 40% of jobs disrupted. What do you think this is? Like they're talking like that's the AI threat. What's your thoughts on this?
Listen, yes, that's accurate, but it's just going to change things, right? So yes, it's going to disrupt the existing jobs, but it's going to force people to think differently, get new jobs, do things differently. It's going to be changed, right? So they said the same thing about cars. You know, it's going to be the end of horses, and then people then got used to horses, and then they got used to cars, and then they'll transition to machinery over handmade goods, and yada yada yada. Time and technology progress. People adapt or die. I believe that people are going to adapt.
I concur. And something that you and I have been doing, Chris, is we actually have brought in groups like Apartment Life. We've been doing resume building workshops. We literally had in this very conference room for all of our tenants here, we did a big workshop where we put all of these modern day platforms where people can go and get new jobs really easy. And we had QR codes for them and stuff like that. So there's just adapting going on. And so people that have this fear that there's a job apocalypse coming because of AI, they just have to wake up to the reality that things are shifting. And I think that they don't have to fear so much about, like having tenants that can't pay their rent. As long as they adapt and they help their tenants adapt, then they're in good shape.
I agree 100%.
Chris,
it's just going to be different. Different's okay.
Yeah, money's still going to be flowing. Chris, next up, we got the ex-Chicago head of housing, so HUD of Chicago.
Wait a minute. Let me ask. I
They're,
gotta ask. Democrat?
I'm not commenting on that part, Chris. So they basically were involved in a $4.8 million kickback scheme where basically this director was hiring a specific contractor and Ryan Ross, and consequently, this contractor was paying kickbacks, and now they just busted them, and now they're facing up to 20 years in prison.
Where they
Your
belong?
thoughts?
Where they belong? Listen, I get so. This is why I am so adamant that we have strategies that we teach people, that we show people how to legally avoid paying income tax so that they can use that money to positively impact the world. Here we go again. More corruption, more fraud, more politicians with doing the things that they aren't supposed to be doing. And it goes over and over and over again. It's like there's so many people that are motivated to hold political office to do wrong because they retire as multimillionaires in 20 years making 50, 60, 70, $100,000 a year. All of a sudden they're worth 100 million when they get out of office. Huh. Here it is. This is just the trickle down effect. That's all this is.
Well, Chris, we I'm going to change gears in you because there was actually a good guy that he wasn't elected to an office, but
Amen.
he was serving in office under Scott Turner. But this gentleman, Frank Cassidy, he spent the last year and a half or so working on HUD, and he just decided to step down now. And in his tenure, here's what he did. Number one, and you'll have to make this speak in English for everybody, Chris. He lowered PMI. He lowered the insurance. What does that mean?
Um, my brain just stopped working. I want to say personal.
Sorry, I didn't give you very good context on this
Uh,
one. So this is there were
what he's
basically
doing is
five
basically
different.
he's making housing more affordable by lowering the insurance rates that you have to take out if you put down less than 20% on a mortgage, right? That's what PMI is. It's that insurance that you go out and buy. And here's the thing about PMI insurance. If you don't put down 20%, they get you a policy, and that policy is usually like 30 years, the length of the mortgage, and you can only get rid of it after like 15 years or something. And so even if you make large payments to get the principal balance down on your mortgage, you still have to pay that premium in most cases. Every now and then you get one shot at getting rid of it. So basically what he did is make it so it's more affordable by lowering the PMI premiums so that you can, I don't want to say borrow more money, but I guess you could borrow more money, but make financing a home more cost effective and easier to do and more accessible to more people.
Beautiful.
It's
And
private mortgage insurance, PMI. Poof, my brain just stopped functioning. Sorry.
the other big one that he's touting, Chris, is that he lowered the length of a HUD loan,
Yep.
like a straight multifamily HUD loan, from 12 to 6 months.
Yep.
What is that in
Oh,
English
so
terms?
a HUD loan is the most desirable loan for multifamily investors because the amortization schedule is longer. The insurance rates, the mortgage rates are lower, and they're assumable, and everybody wants them because they're rock stable. Like they're the premium, the Cadillac of multifamily loans. But the problem is getting them. So let's say if you can imagine that if you're going to buy a property and you need financing, the seller is not going to wait a year for you to get your financing together, right? And that's how long it was taking to finance a loan. What do you do in that case? You do what's called a bridge to HUD. You go and borrow high interest money, sometimes 12%, to carry you through the time it takes from date of application to the date of the actual being able to close on the HUD loan. So you're paying a higher interest rate. So since took it from 12 months to 6 months, you're paying high interest for 6 months left. Therefore, making the loan more affordable and more accessible to more people and to make more transactions happen. Boy, I talk a lot when I'm just trying to give a simple answer. I'm sorry.
Chris, I'm gonna bring in another one on you, and this one's gonna be a bit of a surprise for
You
everyone.
always
But
do.
I found this really interesting. So they're right now everyone's had the crave of going after new construction and newer stuff, but there's a movement right now to go after 60s and 70s multifamily product because they're chasing cash flow. And the current operators that are interviewed in this particular article, they're talking about this product being basically it's priced right. There's value add to it, and a lot of these sellers have some kind of default, so it's making really good cash flow plays buying it. What are your thoughts on this?
So this is a very complex issue. Okay, when I say complex, it's a complex mathematical formula. So as insane as this next statement is going to sound, you have to follow me through the whole story before you cast judgment on me. My lips are not working today. I apologize. So I would rather have a 1960s asset versus a 1980s asset. Here's why. The 1980, early 80s stuff has still got may still have all the problems that have already been solved in the 60s. Plumbing, electrical, those kinds of things very likely have already been addressed in the 60s, era units versus the 80 era units where they're just starting to really ugly heads, or people are skating out at just as these things start falling apart. I mean, think about it. All the ACs have been replaced. Likely there's been one cycle on the roofs, maybe two. So there's a good chance you're getting in there. But because it's a 60 or 70s era property, people are dumping it for pennies on the dollar. Where you can go in there, renovate, bring them up to standards, and boom, you've got a beautiful property. Who cares if the walls were built in 1960? As long as they're still standing, I'm good with it.
Chris, I'm gonna change gears on you again now.
Why not?
You're on a roll, man. So next up, we have a property management company. This started to become a household name called Renters Warehouse. They started going around and buying up smaller property managers in the country, and they were gobbling up. In fact, we sold one of our early property management companies to them, and they are on this roll up play, and they plan to go public at some point. And they went and raised $100 million, and they took it all the way through a SPAC to basically go public. And they got to the I guess it's not technically an IPO, but I don't know the better term for it. But they got
relisting on the exchange.
Relisting on the exchange. They got there, and they were supposed to bring in $400 million. That was the valuation that it was set at. And they only ended up collecting something like $20 million.
That barely covered their legal fees.
Yeah. And they still had the public filing already. So now they got to, pay for all this quarterly reporting and stuff like that. Anyways, they self-implode. Expenses just run them over. And a Japanese company just stepped in and bought them pre-bankruptcy for $8 million. $100 million just sold for $8 million. This Renosi. What the heck just happened? Can you explain that for us?
I don't know, but we really missed the boat on this one. We might have tuned that up and grabbed it for $8 million too, since we're all but self-managed anyway. So let's start at the beginning. What a SPAC is a special purpose acquisition company. Generally, it's a shell publicly traded company that's sitting on the shelf somewhere that's not transacting. Maybe it's on the pink slips for pennies or something. What you do is you take your company, you back it into that, and then reinvigorate that company and go out and do a reoffering or a relisting where you go out there and con a bunch of money into giving a bunch of people into giving you money. That's what they did, right? So their plan fell apart at the 11th hour as a result of the people that were doing the investing, or I imagine the bankers doing the underwriting, finally got under the hood and saw that this company was not making any money, and they were building, a house of cards that was going to come tumbling down, which it did. But I'm here to tell you that was a deal of the century, because those people probably have $8 to $10 million a year in annual revenue as a result of their contracts. So, man, it's crazy. First thing I would do is take it, delist it. I would buy back everything that was out there, and then hold on to that company and just grow it. But man, that was we missed that one, dude. We missed that one.
It even has me thinking about the company that we sold them before they had their epic flop. But even that company alone, it could be knocking on the door of what they paid for it. So It's very interesting to see this.
Yeah.
So unlike the SPAC that failed, we go after more solid plays, and We have one right now. Chris, are you cool if we chat just for a couple minutes about East Ponce Village?
Ah, yeah, I guess. Of course. Let's do this.
It's last round because we're right at the home stretch, final bit of our capital on this particular property. But I'll
Yep.
put it up on the screen. This is East Ponce Village. I'm physically sitting at it right now, Atlanta, Georgia, which Forbes just ranked literally the #2 city in America for workforce housing for this year, which means that they're expecting growth. They're expecting a lot of growth. In this particular campus, what happened with it, we just stole it. It's literally the appraisal came in at 120 million. We got it for $73 million.
Another
The
deal of the
reason,
century.
yeah, and then some. The difference with this one is that there's no speculation. It's already generating income. We already know what it is producing. We know what it can produce, and we're here right now. We're operating it. We haven't closed on it. We close on it just a week and a half or so, depending on the bank's timeline. But we took over the existing debt because the previous ownership group they didn't do things right way. They had the wrong management structure in place, and things got out of control, and they couldn't run the place right. And so we just got literally, as Chris said, the deal of the century. And so we're going through right now and we're renovating the vacant units. And as fast as we renovate them, they are being leased. We have a wait list right now for available units. And so it's really just about getting the team up and running and churning units and getting them leased. Once we finish that whole play, then we're in a position where we can go back to a bank and we can do a refinance. What that means in really simple terms is imagine going to the bank and getting them to put a loan on the property and getting a lion's share of your capital back. And then once you get that back, still collect cash flow from the property, and you still own your percentage ownership forever, or as long as we control this asset. So that's the play here. That's what we're doing. And my favorite part is the refinance. Chris, your favorite part is the tax.
Yeah, I was just gonna say you didn't even hit the favorite part, dude. So listen,
You talk about that.
since we did this deal so well, and we're getting it at such a value with minimal investment on our part, right? We've been able to pull a cost segregation study, and all indication at this point is that we're going to be able to give our investors up to 100% of the basis. Up to 100%. Let's say you're putting in $1 million, we're going to be able to give you up to 100% of depreciation losses in the first year as a result of advanced and bonus depreciation. And what that means is that if you've got the right tax structure, you can write that off of your income and off your passive. But if you've got the right structure, even your right W-2 income. But you can't get that if you don't invest. So, like Nate was saying, this is an amazing opportunity to jump in, get in on a deal that we're going to refinance and refinance and refinance. And when we return the capital to you, guess what? You maintain your position in the asset. So moving forward, when we go to sell, you're going to make out like a bandit again. So you'll get all those depreciation losses. You'll get cash flow. And then you'll get that big chunk of change when we exit. And again, we're buying this at 73 million. It was appraised at 122 million just 3 years ago at this point in 2023. All we're going to do is get it back up and operating normally, and boom, it's worth $123 million again. That's $50 million of equity built right in. So I think there's just a smidge left. I really don't believe there's much left. So now's the chance, now's the opportunity to jump on and get involved in a deal that can keep you from giving money to a government that is fraught with fraud and building bridges to nowhere, and allow you to use that money to have a positive impact in the world like we do. Yeah, and that's all I got to say about that.
So Chris, I have a surprise guest
Uh-oh.
came into the
What did I
conference
do?
room.
Okay.
Yep. And so for those of you that are kind of wondering, like, hey, should I do this deal? Should I not do this deal? We actually have another investor who just came on site. This is Rod. Say hi, Rod.
Hi, good to see you.
And Rod, you're a pretty sophisticated investor. You've been in senior housing. You've done your whole gamut of things. What made you jump on a plane and come out to see this?
You know, a couple different things. I would have loved to use my 1031 that I had come out of a sale, because it's a great way of recapturing there. And you still have some people that are doing that and putting that into place. But beyond that, there's a preferred rate that's built into this based on how much you're putting in, and then a 25% internal rate of return. And that's just recaptured in the first 3 years. And beyond that, it's pure cash, which is a great play. And beyond that, additionally, they're able to give you, through accelerated depreciation, be able to take your whole investment and wash it out against your against the depreciation.
Rod, you're hired.
Even though I heard you're in the last 2.5 million of this, so I'd jump on fast.
Yeah. You hear that, guys?
So Rod, you'll have to tell me how much I owe you for that. But no, Rod's here. He's actually touring it. We got to hang out for just a little bit, going around the campus and seeing stuff and things like that. But it's actually,
and it's impressive. It's they control and manage this whole facility, this site here. It's not the best neighborhood coming around on some of the stuff, but it merges into their own controlled neighborhood, gated community. They'll be able to do the things that they need to do to keep out issues from the outside and do nominal improvements on a good number of the units and come in at $73K per unit, which is way under market.
Yes, exactly.
yeah, we stole it from a basis perspective. The Atlanta market usually trades for about 165 to 175. New construction is 185, and we're buying at 73. So our basis is the protection on this.
Just for example, senior living, you develop out $400,000 per unit. Basically.
Wow.
400K.
400K a unit. Holy cow. I know where I'm not going next.
But there's some components that Nate and I were talking about that may be introduced in something like this.
Yeah.
A service component that could be added in, but anyways.
Rod's got some ideas first, Chris, over on the third phase where they're more ground level.
Yeah.
He knows senior housing really well, and he's talking about how we could really benefit if we advertise to seniors.
Wow. Awesome.
Cool. Rod, thank you, sir.
Nice, Rod.
And thank you guys for tuning into the Opportunity Zone today. Hey, if you're looking for a spot on this one, it's homeinvest.com/book. Or if you're following us online, just type the word call in the comments and we'll send you a message. We'll get you hooked up with somebody on our team. Cool.
Thank you all.
Chris, anything you want to close with?
I just want to remind everybody that God has blessed us with an amazing lives because we follow his will for our lives on a daily basis, and we have positive impacts, and we do our best to be great stewards for the things that God has blessed us with. And I know one thing for a fact: God doesn't love me any more than he loves you. He doesn't love you any more than he loves me. Follow his will, do the next right thing, have a positive impact in this world, and you will be blessed. God bless everybody. Cheers.